Equities are sitting on unusually strong earnings and a huge AI spending boom, just as oil shocks and policy uncertainty threaten to upset the balance. This is vTalkInsight, Equity Pulse Daily for July 17, 2026, where we connect the macro backdrop, sector rotation, and company results shaping today's equity markets. The macro picture starts with a Federal Reserve that markets increasingly expect to keep rates on hold, thanks to softer headline inflation data and slightly less hawkish recent commentary. Short-dated yields have eased, but the long end of the curve remains elevated, which means financial conditions are not loosening in a straight line. Underneath that, the growth data remain robust. Retail sales are still advancing, jobless claims are near 200,000, and early July manufacturing surveys show a rebound in new orders alongside rising prices paid and employment, reinforcing the idea of a resilient U.S. economy rather than an imminent slowdown. The tension is that core inflation is still running above target, and oil-related risks could easily reheat price pressures. Market expectations have shifted away from imminent rate cuts toward a more muddled outlook that includes the possibility of further hikes or additional balance sheet tightening if inflation reaccelerates. Against this policy uncertainty, the earnings engine is exceptional. The U.S. market is on track for a 15th straight quarter of double-digit profit growth, with contributions broadening across sectors rather than remaining confined to a handful of mega-cap tech names, which historically has been a powerful cushion for equities during mid-cycle phases. In global terms, that combination of macro resilience and earnings breadth keeps U.S. equities favored over many non-U.S. markets, especially as the U.S. dollar remains firm and European bond markets wrestle with stagflation risk. For equity allocators, the central macro question is not whether growth is alive, but how long the Fed can support it without blinking on inflation. Headline indices look orderly, with volatility measures still in the mid-teens, but beneath the surface the factor tape has turned choppy. Momentum and high beta segments have fallen on the order of the mid-teens since late June, a reminder that even in a strong earnings environment, crowded trades can unwind violently. At the same time, there are clear signs of leadership broadening beyond the largest technology names. Small caps are showing improved cash flow and more consistent earnings, and financials, including smaller banks, insurers, and asset managers, are described as being in the early stages of a multi-year growth cycle. The performance gap between the best and worst S&P sectors is roughly 30%, which creates scope for rotation toward high-quality companies in underperforming areas. We are also seeing a bid for defensive groups, with consumer staples enjoying their strongest two-day run in weeks, hinting at some risk aversion even as the broader bull market narrative holds. Regionally, U.S. assets still look favored, but emerging markets such as China, Korea, Taiwan, and India are drawing attention on valuation and earnings recovery potential after prolonged underperformance. That said, U.S. equity allocations are already at their highest overweight since 2024, so crowded positioning could limit upside if volatility picks up into the typically tricky late summer period. The defining structural theme remains the AI and technology Capex boom. U.S. technology firms are projected to spend over $1 trillion on investment over the next year to year and a half, a scale that now rivals monetary and fiscal policy as a driver of nominal growth and of the equity narrative. Taiwan Semiconductor manufacturing company sits at the center of that story. It reported very strong earnings, raised its full-year dollar revenue growth guidance toward 40%, lifted capital expenditure to around $60 to $64 billion, and maintained margins near 68%, with that strength spilling over to key suppliers like ASML. Yet TSMC's American depository receipts still fell roughly 3 to 4% on the day, and the broader Philadelphia Semiconductor Index dropped close to 5%. Global chip names are underperforming as investors rotate toward hyperscalers such as Amazon, Microsoft, and Alphabet and question how long AI hardware can deliver outsized gains from already elevated valuations. A key concern is how this investment is being financed. More of the tech Capex surge is coming through capital markets rather than internally generated cash flow. AI-related credit spreads are widening, and some estimates suggest companies could be plowing most of their operating cash into AI infrastructure in coming years, which raises questions about long-term returns. Some see this as a classic bubble that only ends when hyperscalers slash Capex, implying elevated volatility until that inflection. Others argue the bull market is unlikely to be broken by AI alone and that a fresh macro shock, such as a powerful commodity upswing, would be a more likely catalyst, but either way the path for AI-linked equities looks bumpier from here. The other major macro swing factor is geopolitics and oil. Escalating tensions between the United States and Iran have led to repeated strikes, a closure of the Strait of Hormuz that has cut visible transit volumes to under 4 million barrels per day, and efforts by Gulf producers to reroute flows with mixed success. Even with some recent pullbacks, baseline forecasts still place crude above $80 a barrel, with around 85 as a central case, reflecting persistent supply risk and negotiation uncertainty. Energy agencies warn that a prolonged blockage could materially damage the global economy, while higher oil prices would keep central banks under pressure to maintain or even raise rates. For now, equity markets have been able to look through a degree of energy volatility because much of the current leadership is in AI-related sectors that are less directly exposed to fuel costs. However, rising energy prices still feed into headline inflation, strain lower-income households, and could push bond yields higher, reviving fears of a stagflationary mix that typically weighs on equity valuations. Interestingly, United Airlines is showing how strong demand can offset energy shocks. It has raised earnings guidance despite a $6 billion increase in annual fuel costs, is seeing corporate travel up about 30%, and reports fourth-quarter yields already booked around 14% higher than third-quarter levels, helped by fares that remain below pre-pandemic real prices. Turning to company-level signals, the banking sector is a key pillar of the current equity story. Major U.S. banks, including Morgan Stanley and Goldman Sachs, have reported record profits, with Goldman topping its previous equities trading record by more than $2 billion, and peers such as J.P. Morgan and Bank of America also delivering all-time high quarterly earnings. Profitability is being supported by positive operating leverage, faster loan growth, and benign credit quality, aided by a still favorable rate environment and some easing in regulatory intensity. Regional players like Citizens Financial and KeyCorp are expanding investment banking services, and traditional lenders are regaining share from private credit, even as some alternative managers, such as King Street Capital, face withdrawal restrictions after weak performance. In healthcare, UnitedHealth has helped restore confidence by beating earnings and lifting full-year guidance on lower-than-expected medical costs, a notable shift after prior concerns about claim inflation. In travel, United Airlines' upgraded outlook and strong forward bookings underline robust consumer and corporate demand despite higher fuel costs and rising ticket prices. Media and platform names show a more mixed picture. Netflix has dropped around 45% from its mid-2025 peak after a sharp free cash flow miss and softer revenue and earnings guidance, even though it is still growing sales at about 12%, expanding margins, buying back stock, and trading at less than 20 times forward earnings. Uber's acquisition of Delivery Hero enlarges its delivery footprint to nearly 50 additional markets, taking its global presence close to 100 and reinforcing the growth story in logistics and food delivery. At the same time, AI regulation is moving up the agenda, with Anthropic facing export controls and Pentagon-related restrictions that could affect its eventual listing, underscoring that policy risk is now firmly part of the AI equity thesis. Stepping back, equities are being pulled between powerful earnings support, an extraordinary AI investment cycle, and persistent macro and geopolitical tail risks. Breadth is improving beyond megacap tech. Banks and select cyclicals are contributing meaningfully, and the U.S. remains the relative bright spot, yet crowded positioning, volatile factor rotations, and an elevated energy risk premium keep the path forward far from linear. Key to watch now are incoming inflation and growth data, any shift in Fed rhetoric, the durability of AI Capex plans from hyperscalers, and whether oil markets settle or move toward more disruptive scenarios. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.